And you don't ever want to call yourself a GP in a legal context because a GP has unlimited liability. Be careful who you bring into your management company. Like I caution clients, you want to be generous because generosity builds success. You have to do good with others to do good for yourself. So give out carried interest generously. But I say be stingy with your ownership of your management company. Like don't just rush to build a team. Don't like have a shotgun wedding to like build this management company with partners that you haven't dated a long time. You don't know that you're going to be in this forever. I say if it's your brainchild, you own the management company. You own the UGP. And then be very generous with your partners to give them large pieces of the GP of the fund. And if all goes well and you want to do fund 2 together, do the same thing again. You own the management company and be very generous in the GP. Give them big pieces. And maybe over time, maybe even by fund 2, but maybe longer, maybe at some point, you've dated long enough. Now you're ready to get married. You know what? Let's bring you into the management company. So you're a pass-through fund invested in a pass-through startup. The IRS had no address to attack until they followed the money and got to your investors who were sitting comfortably in India or in Canada or in Israel or wherever they are. And now the IRS is saying, hey, pay up your taxes. What taxes? You know, the business that you're running in the US. What business? I'm a passive investor sitting overseas. I invested in this venture capital fund. Passive. Yeah, but the fund is a look through and the portfolio companies a look through. So we looked through them and we found you. That would be bad. So.
Hey everyone, this is Prashant and I'll be your host for the VC10x podcast, and today we have Yoni Tuchman with us. Yoni is a partner at DLA Piper, representing sponsors and investors in forming, investing in, and operating private funds. This episode marks the beginning of a new segment on the podcast called Legal10x, where we will be talking about the legal aspects of funds and startups. In this episode, we will talk about key legal structures commonly used in venture capital fund formation. What is the diamond structure? What is the difference in building a fund versus building a firm? Things that first-time fund managers get wrong, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10x, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast10x is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Yoni, so good to have you on the VC10x podcast. How are you doing?
Great to be on, Prashant. Thank you so much for having me.
Yeah, it's a pleasure having you on. And I think with this episode, we'll be kickstarting a new segment on the podcast, which will be called Legal10x. We'll be talking about the legal aspect of venture capital and startups and so on. But having you on, it's great because we'll be talking about fund formation and fund structures and so on. And a lot of fund managers have to navigate that. So great to have you on, and thank you for making time.
It's a great pleasure. It gives me an excuse to talk about that which I love. So thank you for giving me the opportunity.
Great. Let's get straight to it. So what are the key legal structures that are commonly used in venture capital fund formation, and how do these structures impact fund formation and fund operations?
Structure-wise, I like to think of it as two parts. You're thinking of the fund itself. That's like on the bottom of the page, if you imagine a page of a structure chart. There's the fund, and the fund could be one vehicle, it could be two vehicles, it could be any number of vehicles. 9 times out of 10 for a venture capital fund, the fund is just one vehicle. It's one limited partnership. What I mean is, sometimes people have a misperception that because there's maybe multiple types of investors, like US and non-US, tax exempt and taxable, therefore we need something more complicated. And the truth is, in venture makes it easy. 9 times out of 10, it's one limited partnership. That's the bottom piece. So there's not much to talk about there. One-off cases may necessitate, if there's a compelling reason, something more complicated than a single vehicle. But 9 times out of 10, a single vehicle is good. The other piece of this, the second piece, is everything that's on top of the fund. What do I mean by that, Prashant? There's a management company. That's an entity that has employees or consultants. It has office space, rent, other overhead. That receives a management fees. That's one entity. We like to keep that separate from the general partner of the fund. And when I say general partner, don't misunderstand. A lot of people think general partner means the guy or gal or folks that are the GPs of the fund. It's not what I mean. They're not the GPs of the fund. They're the owners of the GP of the fund, but the GP is an entity. And you don't ever want to call yourself a GP in a legal context because the GP has unlimited liability. So don't call yourself a GP in a legal context. You can call yourself a GP in parlance and how people talk. The GP entity that has unlimited liability in the case of a fund that's a limited partnership is a separate entity. So right now, if you stop, we have 3 entities we talked about. Even in the most simple fund context, we have the fund at the bottom. It's a limited partnership, 9 times out of 10, or 9.9 times out of 10. And then we have a management company, which receives management fees and has the expenses. And then we have a general partner. Think of an upside down pyramid. The point is at the bottom, and then we have these 2 entities above it, the GP and the management company. So we could stop there, but then how do you, let's say, Prashant, you're forming this firm. How do you control, how do you own the management company and the general partner? So what makes a lot of sense is that you have an entity that controls both of those things, which ends up looking like this. So now you have a diamond shape. You would own an entity at the top. Many call that the UGP, the ultimate general partner. That's just an entity that you, Prashant, as the GP of this fund, GP, colloquially, control everything. Control the management company, control the GP, and through those entities, control the fund. That's not like that. That's the right way to structure this 9 times out of 10. You can avoid the UGP if you wanted. You can kind of chop that piece off and just have 3 entities. I don't see much benefit in that. I like this diamond structure, but that's a structure that we recommend for a lot of reasons, getting into like details, which is going to be kind of probably too involved. But that I think is the right structure in the vast majority of cases.
Right. Yeah, that's quite interesting. So what is the GP called in this legal structure? So by GP, I mean the person who is making the investments, who is in charge of everything.
Yeah.
What is that person called in the legal context?
I mean, in the legal context, there's not really a name for that person. I mean, contractually, the different documents will refer to that person or those people, however the lawyers kind of refer to them, right? Each law firm probably uses different terms. In the fund, in the document of the fund, the governing agreement, the limited partnership agreement of the fund itself, those people are maybe referred to as the key persons. In the old days, they were referred to as the key men. When I was a young lawyer, key persons is a very appropriate way to refer to them, a very typical way to refer to them. I've heard them referred to as the principals, the active managing partners, things like that.
Got it. Interesting. And so, by the way, I'll try to put that structure that you're talking about on the screen on our video, which goes out on YouTube and even on Spotify, so people can find it there. And what makes the diamond structure so good? What are the key benefits of it over the other structures that are there?
Yeah, good question. Let's start from the bottom. I mean, there's not really much disagreement as to what entity type the fund should be. I mean, it's virtually always a limited partnership. In the U.S., if there's any nexus to the U.S., it's typically a Delaware limited partnership. It could be a Cayman limited partnership if there's tax reasons not to have an onshore vehicle. It could be a Canadian limited partnership. We have funds that are based there. So think of a limited partnership as the fund. Not really much to discuss there. Although some funds are structured as limited liability companies, LLCs in the U.S., very rarely, certainly not in venture. Sometimes you see real estate funds like done that way, I think for historical reasons. Um, but there's not any benefit to an LLC. Let's say you wanted to form the fund as an LLC. Let's say you didn't know better and you said, well, I've done other investments through LLCs. I'll form my fund as an LLC. That may be fine. The issue that will arise, likely, is if you make investments outside the US. If you're a US fund investing in the US and then you make investments outside the US, I'm not a tax lawyer, but I've hung around tax lawyers enough to know that non-US jurisdictions, vast majority of cases, if not all, they treat LLCs, limited liability companies, as opaque, as corporate in nature from a tax perspective. In the US, the IRS, the Internal Revenue Service, thinks of LLCs as limited partnerships, I should say, for tax purposes, unless there's an election made otherwise. So you get what they call a hybridity issue, where non-US jurisdictions are looking at your fund as a corporation, and the IRS in the US is looking at it as a partnership, and that could create tax problems or tax inefficiencies when you're investing overseas, because you have the different jurisdictional tax authorities coming to loggerheads, and it could, for example, jeopardize your ability to capture tax treaty benefits that, let's say, a non-US country where you're investing may have with the US. Your ability to benefit from those treaties may be disrupted if there's a corporate entity in the structure. And you'll say, but there is no corporate entity in the structure. It's an LLC. We tax that as a partnership. Yeah, you do, but the country you're investing in doesn't. So let's pause there. That's why the fund itself should be a limited partnership, as opposed to a corporate type of entity like an LLC, which outside the US is treated most of the time as a corporation, tax-wise.
Great.
Then you move up the chain. So far, we're only talking about that little tip, and there's not much disagreement there. You don't really see venture funds formed as LLCs, even by those who don't know better, because they just pick up the other guy's fund. It's a limited partnership, so they also do it as limited partnership. Then you move up the chain. Remember those two, we got this upside down pyramid here. You have the management company. The question is, what type of entity should that be? Should the management company be a limited partnership like the fund? Or could it be something else? Could it be an LLC? Could it be a corporation? Again, for a venture firm for sure, 9 times out of 10, what we suggest, it's a limited partnership. Just like the fund. Why? Different reasons. I can get into the reasons, but it might be too much in the weeds. It gets into archaic tax law and a recent tax ruling. But put it this way, talk to your tax lawyer if your management company should be an LLC or limited partnership. What we recommend to clients who are forming their firm, we talk them through why, and we say, you should do it, in our opinion, as a limited partnership. There's no downside. There may not be upside, but there may be upside. There's this thing, I can't help myself. I'm sorry, I can't help myself. There's this thing called self-employment taxes here in the US. And without getting into the details, A, because it's probably not the time, and B, I'm not expert in it. But again, hanging around with enough tax lawyers, let's say your management company receives $100 in management fees this year. Okay? And let's say of those $100, you use for your expenses and overhead and whatnot, $90. So you have $10 of extra management fees after salaries and after all your expenses that you, as the owner of the management company, want to just take at the end of the year. There is a small percentage of tax. It's like 2.9% tax on that $10 that you could avoid potentially if your management company is structured as a limited partnership rather than LLC. And you'll say, why in the world is that? That makes no sense. Welcome to the tax code. It's a statutory exemption that can be sought by a partnership and not an LLC. But there was a recent tax ruling last year, just very recently, that said, no, an LLC is a limited partnership. They're the same thing. If you have a limited partnership, you cannot take advantage of this tax savings the same way you couldn't if you were an LLC. That tax ruling, the tax bar, to my understanding, thinks was wrong. It just violated the words of the statute, and it's being appealed. So if you want to preserve the best argument that at some point you can save this, I think it's 2.9%, if I'm not mistaken, on the excess management fees that are paid out by the management company to the owners of the firm at the end of the year, then you are better off to form your management company as a limited partnership rather than an LLC or some other corporate entity. There are other ways to kind of try to skin this cat, but this is one. Let's move to the other side of the screen, right? We have the limited partnership at the bottom. That's the fund. We have the management company, which could be an LLC. We prefer limited partnerships for this self-employment tax kind of potential benefit. And then we move to the general partner. We like to do that as a limited partnership. Okay, we're very biased towards limited partnerships here. They're so flexible and so clear and clean and certain in terms of the tax treatment of them. Remember what we said why the fund itself ought to be a limited partnership rather than something like an LLC? Because all jurisdictions respect and treat limited partnerships as partnerships for tax purposes. That includes a general partner. So for the same reason that your fund, if there's going to be any nexus outside the US, should be a limited partnership rather than an LLC or another entity type, so too the GP for the same reason. Because we want to capture all the potential tax treaty and other benefits. We want to have the same language being spoken by all the taxing authorities, the US and the non-US taxing authorities, all through up your chain, wherever money's flowing. And when your carried interest is flowing from your fund to your GP entity, we want all the jurisdictions to know and speak with one voice. Oh, yes, that's a partnership. I'm not going to say, oh, no, Canada thinks it's a corporation. India thinks it's a corporation, right? The US thinks it's a partnership. We don't want that confusion. So that's why. And if your venture firm, if your venture fund is in the US, will only invest in the US, there's no nexus outside the US. It's a rare fund, by the way. They do exist. So in that case, there's not a potential benefit to forming your GP as a limited partnership rather than LLC. But what's the downside of forming it as a limited partnership as opposed to an LLC? To me, it's a no-brainer to do it because there's no downside. There's only potential upside. I didn't think I was going to invest overseas, but then I had a great opportunity, right? So that's kind of how we think about it in a nutshell.
Right. Quite interesting. Yeah, I've interviewed a lot of GPs, and some of them say that we only invest in Delaware C Corp registered companies, right? Why is that? You're an expert in this, so you'd know better.
Yeah, I mean, I think as a practical matter, it's true because most of the companies, most of the startups that they're investing in happen to be structured that way. It's not that they're necessarily requiring it, but in the US, startups are structured as C Corps. It's so easy, it's so inexpensive, and it's so routinized. The documents, they're all forms at this point. They're all forms. All the companies, all the law firms, the NVCA, National Venture Capital Association, check out their website. They have forms of the, shareholders agreement and the bylaws and the, I don't know what these documents are. It's not my field, but the ROFO and the co-sale agreement. So it's just very, very routinized. Most of the time, that's how startups are structured. And that's why not most of the time, that's what venture funds are investing in. Now, there's a benefit to that, though, also for venture funds. What's the benefit? If you have non-US investors, They don't file tax returns in the US, right? They don't pay taxes to the IRS in the US. Wouldn't it be bad if by investing in your fund and by your fund making an investment in the US company, all of a sudden, your very happy, contented non-US investor suddenly has to A, file tax returns, hire an accountant in the US to file tax returns to the US, and or B, pay tax in the US. Wouldn't that be a shame? Wouldn't especially be a shame if it happened by accident and you didn't plan to avoid it and they didn't know it was going to happen and then they're socked with this. Ugh, that would not be a happy event. How could that possibly be? It could possibly be if your fund, which is a pass-through, it's a partnership, it's invisible to the IRS, so to speak, doesn't pay taxes. It passes through the income and gain to the owners, the limited partners, to the general partner. They're the ones who are on the hook for the taxes of the entity. If that pass-through invested in a company, in a startup that was structured as another pass-through, we have a pass-through doing business in the US, creating widgets and selling widgets. That entity, that startup, is invisible to the IRS. It's a pass-through. The IRS looks through it to its owners. Who are its owners? Your fund is one of the owners. So the IRS focuses on the fund. And then you say, our fund is a pass-through. Our fund is invisible. It's transparent. Okay, let's keep looking, says the IRS. And who do they end up hitting? Your investors. What a tragedy. Because your pass-through fund invested in a pass-through startup, the IRS had no address to attack until they followed the money and got to your investors who were sitting comfortably in India or in Canada or in Israel or wherever they are. And now the IRS is saying, hey, pay up your taxes. What taxes? You know, the business that you're running in the US. What business? I'm a passive investor sitting overseas. I invested in this venture capital fund. Passive. Yeah, but the fund is a look through and the portfolio company is a look through. So we looked through them and we found you. That would be bad. So when the portfolio company is a corporation, we don't have this problem. The IRS looks at the company, the startup, and it says, oh, I know who to tax. There's a legal person here. There's a corporate entity here. Let's tax that thing. And then the dividends from that corporation are passed up to the look-through partnership. IRS says, okay, those are dividends, all good, and it passes through up to your investors. So this is funds tax. I would say it's not even 101. It's the pre-101, right? I'm not a tax lawyer. A tax lawyer will find details of what could have been improved in my little recitation. But as a storyteller, this is how I would describe the benefits to answer your question of why do venture funds invest in C Corps? And so again, the answer is twofold. A, because that's how startups are structured most times in the US. So that's what's available. B, there is a benefit because as a corporate entity, as an opaque tax entity and not transparent, the IRS doesn't follow the money past that to then bring your investors on shore. Now, that raises, if I can digress for a moment, Prashant, is it okay if we digress for a moment?
Sure.
One of the first things to think about when you're raising a fund is who are my potential investors? I don't mean what are their names. I mean, what are their attributes? And mainly what I mean is, are they US or potentially non-US? Are they taxable in the US or are they tax exempt in the US? That's one of the first questions we'll talk through with the client, like one of the very first questions. Because if you're building something, you have to know who's going to be living in this building in order to build it to suit. So we have to know who are the inhabitants, who are the residents of this building we're constructing, this fund. And we're going to build it differently, potentially, if they're going to be US tax-exempt investors versus US taxable versus non-US. And so that's one of the questions that we'll ask. How does it make a difference? How do we build this differently? If it's a U.S. owned residence, or there will be non-U.S. residents in the fund or tax-exempt residents in the fund. We want to avoid the scenario that we just described, where by accident, all of a sudden, your investors who either are overseas and therefore don't have to file or pay taxes in the U.S., or they live right here. They live in New York City, for example, Los Angeles, Chicago, wherever they live, but they don't pay taxes or they don't file taxes because they're exempt. And if that's the case, they'll be hit potentially with these tax obligations, potentially if there's all pass-throughs in the structure like we discussed, and the IRS is focusing on an address to find for the tax obligations. If your fund, which is a pass-through and therefore is invisible, invested in a startup, which is a pass-through and therefore was invisible. So the same issues, very much the same issues that could potentially adversely impact non-U.S. investors who don't pay taxes here could also adversely impact U.S. investors who are tax exempt, like endowments, pensions, IRAs, all of these type of very common venture fund investors. So you could say, okay,
Yep.
but I'm a venture fund. So I'm only investing in, like Prashant said, C Corps, Delaware C Corps. Didn't Yoni say that those are okay? So there's nothing to worry about. Yeah, those are okay. Well, once in a while, you'll find a deal that's not structured that way, right? And maybe more than once in a while. And so what happens when you find that deal, you find that startup that for whatever reason is not structured as a C Corp. It's an LLC. It's taxed as a partnership. Then we have a problem on our hands, don't we? Because we weren't thoughtful building this building. We built it, I use a silly example, popped into my head. We built it without the rain gutters, and now it's raining, and the water is pouring into the windows. Shoot. But I built it in Los Angeles, and I didn't think it was going to rain. Yeah, it doesn't rain a lot, but once in a while it rains, once in a while. And you don't want to build a house in LA without the rain gutters, right? I'm having too much fun, sorry. So that's why when you're building this fund, you want to be thoughtful. Who's going to be, yeah, it's in LA. I'm investing in startups. Those are C Corps. It never rains. But once in a while it will. And once in a while you'll find a good deal that's not a C Corp. So you want to build in the protections into your documents today that give you the roadmap, how to deal with that scenario if and when it comes. And more than that, you want to tell your prospective investors, hey, I know what I'm doing. I'm being thoughtful in my design of this structure and in the terms that I'm going to sell to you. I know that this is a potential. I know that it's maybe not likely, but sometimes it rains in LA. And I want to be prepared. So here are my gutters. Here are my water spouts that are going to direct the water away from the house, away from the foundation, out of the windows. And so what do we call that? We call that a covenant, a promise, a pact to move this bad income that would arise if the fund were to invest in a pass-through, in a partnership, an invisible tax-wise portfolio company. We will deal with it. We're aware that that will be problematic for you, investor, non-U.S. investor or tax-exempt U.S. investor. And we'll tell you today how we're going to solve that in the future if it should come up. Now, you can always solve it in the future without baking into the DNA of the fund how you'll solve it. You just have to be savvy. You have to be aware when you're making your investments. Hey, I might have to talk to a lawyer because this is a non-U.S. I have non-U.S. investors or tax-exempt investors, and I'm investing in a pass-through, right? So you could just have a checklist in your back office and think about that and raise it. But wouldn't it be better when you're selling your fund, when you're fundraising, to tell your investors, hey, we've thought about this. Don't worry, we got your back. We thought about this for you, and this is how we're going to deal with it. So many times we'll always have this conversation with the new client or any client doing a new fund. We'll talk through this. Might you have non-US investors? Might you have tax-exempt investors? You want to have the flexibility to do that, even if you may not end up having those investors. Great. We got to put these rain gutters on the building. And how do we do it? You put this covenant in that tells these investors, hey, on the off chance that we think it's likely that we're going to incur this bad type of income for you, we're going to solve it by structuring that investment through what we call an AIV, an alternative investment vehicle, AIV. An AIV is just another vehicle. It's not formed as part of the formation of the fund. It's formed in connection with a particular investment to facilitate the fund's investment in the optimal way into that portfolio company, and will attach within that structure, within that new structure, which we create specifically for that, problematic investment, a corporate entity. And remember, the corporate entity blocks the bad income. It's called a blocker. That's why it's called a blocker. A blocker corporation. What is it blocking? It's blocking the bad income. I don't even like to call it a blocker corporation. I think of it as a purifying corporation. It doesn't block it, it converts it. It makes it good. It makes it whole. It makes it clean. It takes bad income from the operation of a U.S. business and it turns it into a dividend from a corporation. Beautiful. Now you're clean. There are downsides, right? Because corporate entities pay taxes. So there's no such thing as a free lunch. You want to cleanse. You want a cleansing corporation, what other people call a blocker. It's going to save your non-U.S. investors from having to come on shore, but it's also going to add a level of taxation. So you'll have a tax lawyer on your podcast, and you could really get into the details of these blocker corps and how they work and how you could leverage them and all the nuances. But what I like to do as a funds lawyer, who again, I speak a little bit of tax lingo, but probably a little more than my clients. So I like to be the translator. Okay, let's just talk tax like a dummy does. I'll be the dummy. I'll talk tax. I'll say it in an easy way. You understand me because I'm just telling you as much as I understand it. But that's really all you need to know for now. So that's really, I know we went a little bit on a tangent, but how do you structure a firm? This is how you structure it. Why? That's why. Investing, how does that impact the investments of the fund and your investors? That's how. So a little bit of a sausage over there.
Love it. You're a great storyteller. I think your alternate profession should be a teacher, right? The way you explain things.
It's
to someone
funny.
who
Thank
doesn't
you.
know. Yeah, it's great. Thank you for doing this. And I think will be very beneficial for our listeners to learn more about fund formation. And something I have heard from you talk about a lot is how fund managers should be focused on building a firm and not just a fund, right? So can you share what is the difference between the two?
Yeah. It's that I hate to sound like a broken record, but it's that diamond. I mean, people think of a fund, but the fund is one entity. The fund is that one entity, super important. I mean, that's the entity that's doing the action, right? That's raising the money from investors, that has the limited partners, that's making the investments, that's sharing the profits. That's certainly why we're here. That's why the GPs, right? The key persons, the principals, the managing partners, the founders are putting this thing together. But just my point is don't lose sight that there needs to be almost a constellation of other entities involved in this, right? And these entities are going to survive the fund. Your fund is going to have, let's say, a 10-year life. And like all wonderful things, it's going to, at the end of the day, pass away. When it's old age and has been fruitful and multiplied and been very prosperous, it will lie down and rest. But you're not, and your firm is not, because at that point, you're already off racing in Fund 2 and in Fund 3 and an opportunity fund that make later stage investments in your portfolio companies and your SPVs and co-investments. And you have so much life in you but that first fund is now buried. So you got to build all of these entities, and I don't mean to say it's 6 of them, but it's probably 2 or 3, like we described, that are going to survive. And if not survive, replicate, right? What survives and what doesn't survive? Remember those 4 entities we talked about in the diamond. So 2 of them are unique to the fund, and 2 of them are not unique to the fund. What do I mean? The fund is unique to the fund. The fund doesn't touch anything else other than itself. It's a fund. It will have a lifespan and it will die. It will be dissolved. The general partner of the fund is unique to that fund. When that fund goes away, that GP entity goes away. Why? Because that GP entity, remember, said, don't call yourself a general partner. If you put on your pants one leg at a time, don't call yourself a general partner legally, because you're then accepting liability that we don't want you to have. The entity has that liability. When that liability is gone, when the fund is gone, wind up that entity and bury it. Okay? When you form Fund 2, you form a new GP. Don't use the same GP. Now, you could use the same GP. Look, everything I'm saying is from my perspective, my humble perspective, optimal, ideal. But it's not necessarily the cheapest way to do it, right? And it's not necessarily that if you do it differently, it's fatal. So we're dealing with shades of gray here, right? You could use one GP entity for 10 funds. What are the chances that there's some explosive liability at one fund and there are creditors and claimants that sue your GP of that one fund, and because you were too, cutting corners, and that one GP is not only the GP for that fund with a liability, it's also the GP for 9 other funds, and now you've infected the GP of 10 different funds with the liability and the claims of one fund. What are the chances that happens? Probably pretty low. Okay. But do you want to roll those dice? How expensive is it to form a new entity? Not that expensive. So, and to maintain, it's probably worthwhile as nothing but like a little insurance policy. Let's keep everything separate. Also, why are there other reasons to keep the GP separate from fund to fund to fund? Because very often in venture, it takes a village. I think Hillary Clinton said that. It takes a village, and it takes a village to raise and manage venture funds. And a lot of times there's not complete overlap among the villages. So you may form Fund 1, and you may have 3 people helping you with Fund 1. And you incentivize them. You want them to really be invested. So you say, if this fund does well, you 3 are getting a piece of the carried interest. They're working hard. But life happens as life does. And then when you're ready to raise Fund 2, a few years later, the same 3 people are not still at the firm. Maybe 2 of them are. Maybe none of them are. You have new people. So you want to incentivize these new people to receive carry in Fund 2. That's pretty hard if the GP of Fund 1 is the same entity as the GP of Fund 2. Because then you got to do a lot of plumbing in this entity to have different classes potentially. One class relating to Fund 1, one class relating to Fund 2. Let's keep it simple. Let's just have a new entity that's owned by the right people who are working on Fund 2, so there's no overlap with the people who are working on Fund 1 and in their relative percentages. So someone junior in Fund 1 may have a very small piece of carry. Maybe they did really well and they stuck around, and now it's Fund 2. And you reward them for their loyalty, for their service, for their productivity. And now they have a larger stake in the GP of Fund 2. Keep it separate. Give them a bigger piece of GP of Fund 2. So that's why, those are a couple of reasons why we'll often have different GPs per fund. A side point. What I said just now is not totally true. Because if you have, and I don't want to get too far afield, but if you have, let's say, if you have a fund and then you do an SPV, let's say you do a co-investment into a portfolio company of Fund 1. You raise some money from your LPs or from third parties, and you syndicate an excess deal or excess allocation that you have into a portfolio company or a follow-on into an existing Fund 1 portfolio company. You'll form a separate entity for that co-investment or that follow-on investment. Very often, we'll use the same GP to manage that co-investment vehicle as we use to manage Fund 1, right? It's all the same portfolio company, right? And it's the same team working on it, and so just use the same GP. So I'm not suggesting to be slavishly obedient to this rule to isolate liabilities. Every vehicle should have its own GP. That's taking it a step too far. Be smart about it. But generally, each fund and its related investment vehicles has one GP. And each new fund and its related investment vehicles has its own GP. So coming back to where we began, we have this diamond. There's 4 entities. There's the fund and the GP on the one hand. Those are unique to each fund. There's a new fund. That means there's a new fund and a new GP. But the other 2 entities in the diamond structure, which remember what they were, the management company and what we call the UGP, the ultimate general partner that controls everything, those 2 entities will survive Fund 1. The same management company that manages Fund 1 will manage Fund 2 and will manage Fund 3 and will manage the SPVs, the co-investments, and the opportunity funds and everything. Often. And therefore, the UGP, which controls the management company, also will survive Fund 1 and Fund 2 and Fund 3. You could have, as a digression, you could have multiple management companies. I've seen that rarely in funny circumstances. Like I'm doing, a Fund 1. It's my brainchild, and I bring on these partners to manage it with me in the management company. Not just in the GP of that fund, but we're owning the management company together. And then we don't want to move on together, but I want to raise a new fund. That management company has got, this dead weight in it, right? It's got these other partners who help me manage Fund 1, but they're not going to be around to manage Fund 2. So in that case, I form a new management company. That gets a little funny, right? Because you don't want to rebrand, right? So it's like XYZ management for Fund 1. That's my brand, XYZ. Like, so I want to be XYZ management for Fund 2, but I can't use the same XYZ management because I got these other partners there who are not participating in Fund 2. So it's like a little funny. Maybe I call it XYZ2 or something, So that's possible, but that's why you got to be really careful. Again, I'm just, stream of consciousness, but be careful who you bring into your management company. Like I caution clients, you want to be generous because generosity builds success. You have to do good with others to do good for yourself. So give out carried interest generously. But I say be stingy with your ownership of your management company. Like don't just rush to build a team. Don't have a shotgun wedding to build this management company with partners that you haven't dated a long time. You don't know that you're going to be in this forever. I say, if it's your brainchild, you own the management company. You own the UGP. And then be very generous with your partners to give them large pieces of the GP of the fund. And if all goes well and you want to do Fund 2 together, do the same thing again. You own the management company and be very generous in the GP. Give them big pieces. And maybe over time, maybe even by Fund 2, but maybe longer, maybe at some point, you've dated long enough. Now you're ready to get married. You know what? Let's bring you into the management company. And we've had clients that started out solo owners of the management company. By Fund 2 already, they brought their partner in. And now it's 50-50 owner of the management company. That's great. They spent the time, they invested together, and they know they're doing good together. And they see a long-term vision. So that's also a possibility. But be careful in the beginning. Be stingy in the beginning with your manco. That's what I say.
Yeah, that's quite interesting. And I think a very important learning for a lot of first-time managers out there who don't know how to figure it out, how to structure it, and there is partner splitting that happens often and kind of throws everything out of place. But that's good to learn how you should structure it to ensure the longevity of the firm, right? Great. And let's talk about the limited partnership agreement, the LPA, right? So when you're setting up a new firm, what are the key elements or the critical elements of the LPA that should be there always?
How much time do we have? We need a week. Like we could do a conversation on every provision, right? There's so much to
Yeah.
talk about.
Hmm.
But big picture, your LPA, your limited partnership agreement, it's everything. I mean, it's everything. Between the GP, meaning the founders of the firm, and the investors, it's everything. It has to govern all the economics. How money comes in, when, how, and how money goes out. Those are the keys, right? Money coming in and money going out. Those are the keys. But then everything else, I mean, there's so much to talk about that an LP would care a lot about, less so the GP. What I like to do is share a summary of terms with the client. I call it like everything you were afraid to know about a fund. I'm gonna shine a light on it. Like things you didn't realize existed. Let's talk about it, right? And we just go through everything. Every decision that I want a client to have thought through. Here's the problem, okay? Let me just anecdotally. I just had a conversation with a client. They're raising their second fund, and I didn't work with them in the first fund. They discovered well into the life of their first fund that their management fee is lower than they thought. Why? How could that happen? They told their lawyer, and this is not to cast aspersions. This could happen if there's not great communication. They said, we want a 2 and 20 fund. That's very common, right? 2 and 20. Wake anyone up in the middle of the night, ask them what the economics of a venture fund is, and they're all groggy, and they'll go 2 and 20, right? 2 is the management fee. 20 is the carried interest. So they said to the lawyer, I want 2 and 20. But when they said 2, they thought 2 means 2% of commitments every year for as long as the fund lives. But the lawyer who drafted the LPA didn't realize that's what the client was thinking. So they drafted it the way they interpreted 2. They interpreted 2, not incorrectly, by the way, as a market term, as 2% of commitments during the investment period, stepping down to something less than 2 after the investment period. So, sadly, surprisingly, this venture fund and the investors in that venture fund, who were all aligned on paying a 2% fee for 10 years, they actually all signed up to a deal that paid a 2% fee for 5 years and a 1% fee for 5 years. But the client said 2 and 20. Yeah, but translate 2 for me, right? There's so much embedded in these terms that if you're not communicating, if you're not discussing what these things mean, mistakes can happen. So the first call that I have with the client, we talk about the structure that we talked about, the diamond and why and all of that. Then we talk about what you're raising now, Prashant. Let's talk about the terms of your fund. But let's go through it like adults. Like, can we really talk about this? Like, let's not cut corners. Let's not use code words. Like, let's really delve in to the details of what this should look like. I want a 2 and 20. Can we move on? No, we can't. I'm sorry. What do you mean by 2? And by the way, what's gonna reduce that 2%? because there's a few things that typically reduce your management fee. Like, what if it costs you more than you agree with your investors to raise this fund? You exceed your organizational expense cap. Do you have a cap like that? Will your investors expect it? What if you exceed it? That typically reduces your management fee. What if you hire placement agents to find you investors? And you pay them out of the fund. That will reduce your management fee. So, like, let's talk about what 2 means. We could have a conversation about 2 in the 2 and 20. What does 2 mean? When is it paid? Quarterly or differently, in advance, in arrears, right? 2% of what? What reduces it? So there's a lot that could be talked about at every point. So that's my, big picture way of answering the question. Let's talk about the terms of the fund. I would say which term. There's so much to delve into.
Yeah, absolutely. Yeah. Like we have talked on the podcast a lot with a lot of GPs and managers, and we have, very casually used this term a lot, 2 and 20. But it's important to note that when you're talking with legal firms and you're drafting legal documents, talking with the lawyer, it's important to, get into the nitty-gritties because that clarity needs to be there. So one more question, which is about what are the common pitfalls that you see first-time fund managers make when they are forming a venture capital fund?
I have one answer for that, and the answer is, and I've seen this rarely and in earlier days. Sometimes clients are overly excited, and they'll go too far too fast, and they end up with documents and structures and entities that have been prepared and formed, and the cost that's involved in all of that without a fund to pay for those expenses. So I'm very cautious with a first-time fund, and I'm somewhat cautious with a second or third-time fund, and not really so cautious with more, advanced funds in terms of their longevity. Don't go too fast. Be patient. Slow and steady wins the race. Let's just design this. There's 3 steps I tell everybody. There's design. Spend a little bit of time, a little bit of money designing the firm, designing the fund. What's the structure? What are the terms in detail? Go market the fund. And then when you have a line of sight to a closing, what gives you that line of sight? Investors, not excited GPs. LPs say, okay, GP, I get it. I get the vision. I'm comfortable with this. Let me see now, please, the legal documents so I could commence my legal due diligence. Then you can go erect this edifice that we metaphorically referred to earlier. First, design it. Take your time. Don't go too fast. Only build it. You know that movie, Field of Dreams? If you build it, they will come. It's not true in venture funds. Don't build it hoping they'll come. Only build it once they're knocking on the door. But you have to design it to get them to knock on the door. So that's the one thing I always try to be careful that clients shouldn't mistakenly get too excited. This has been great. I enjoyed talking with you, Prashant. Thank you.
Yeah, I love it. Yeah, for the limitation of time, we'll try to limit it here. But I think if you permit, we'll also do a sequel where we'll cover more aspects to fund formation and also fundraising, which is something we could not touch upon in this episode. But I have to compliment you on your great storytelling skills and how you went into and explained everything like you were explaining it to a child. Let's say the person who isn't familiar with these sort of things. So thank you for doing this, Yoni, and I'll be looking forward to having you on again to talk more about such things. Thank you. And do let us know where can our listeners and people who are viewing this can learn more about you. I know you post a lot of insightful content on your LinkedIn. That's how I found you. And also, where can they learn more about DLA Pipers, where you work?
Yeah, thank you for asking. I try to share information freely and often on LinkedIn. I have a YouTube channel and I'm on X, but mostly on LinkedIn. And find us at the website of the firm, DLApiper.com.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, and I wish you all the
Great
best.
chat.
Thank you.
Thank you, Prashant. Until next time.
Awesome. Likewise. Awesome. Next time.